Okay, well, great. Good morning to everyone, and thank you for joining our webcast. So, by way of quick introduction, my name is Ryan Sheriff. I'm a portfolio manager here at Open Access, and I'm very pleased to be joined by Rob Campbell, who is a portfolio manager at Mawer Investment Management. So, good morning to you, Rob, and thank you very much for connecting with us.
Morning, Ryan. Thanks for having me on.
Yeah, I mean, so a lot of you in the audience, you'll know that open access is different than your typical financial advisor. So, we're not affiliated with any bank or insurance company. We're proudly independent. And what that means for you as a client is that rather than only investing in a limited number of funds, we're free to scan the entire market. And in fact, we're monitoring over 875 different investment funds on your behalf. And one of the funds that consistently rises to the top of our monitoring reports is Mawer Investment Management. As you'll see, they've done quite well for you this year, given that your open access account invests in some of their funds. And this performance is very much in line with their long-term track record of outperformance. So as mentioned, we're very excited to have Rob join us today. So as an institutional portfolio manager, Rob does a great job of going behind the numbers. So you're not just looking at that headline return, but providing insight into how those returns are generated. And so this is a great opportunity for you to learn more about the investment strategy at Mawer and how your money is actually invested. So we'll spend the next half hour or so giving you a better feel for Mawer and how they've been able to add a lot of value for you. And following this, we'll open it up to questions. So, please feel free to keep those in mind. So, Rob, I thought I'd kick it off by, the people in the audience today that are hearing and seeing from Mawer for the first time. Hoping you can give us a background on the history of the company, the size of the company, and really what this company means by the art of boring.
Sure. So yes, we're close to a 50-year anniversary. Mawer was founded back in the mid 70s, really at the height of the first oil boom in Alberta, which is funny to think about these days. But the gentleman that you see on the left-hand side, that's Mr. Charles Mawer, and he effectively set up an investment counseling firm with two rules in mind. The first was don't lose money. And the second one was see rule number one. And so the idea of thinking of risk in terms of impairment of capital and doing everything that we can to make sure that we minimize those risks has been something that has stuck with us from day one. Another aspect of who we are, I think Ryan alluded to with respect to open access, is that we too are 100% independent. And so we're an employee-owned organization. We see lots of benefits to that with respect to being able to attract and retain talent at the organization. But it really frees us to make the right decisions in the best interest of our clients. And so our independence is another important aspect of who we are. The last piece, and Ryan, you mentioned be boring, make money, which is our marketing tagline. There are a couple of different elements to that, but I think one of them is just keeping things simple. Investing can be a very complex endeavor if you choose to make it so. And that's not to say that investing is something that's easy. But we make a concerted effort to keep things as simple as possible. One of the ways that we do that is we've got a single investment philosophy that goes across the entire firm. We're not trying to be all things to all people. We're really trying to pick, one belief system, stick to it, and really be predictable in that regard for our clients.
Right. Yeah, and what's interesting is that, when you compare the glamour stocks that everyone loves to follow, the Netflixes, the Amazons, the Teslas of the world, compare those to these boring companies that, these everyday companies that tend to fly under the radar. They tend to produce better returns in the long run. So I was hoping you could speak more to the company's investment philosophy and specifically the idea of finding these wealth-creating companies.
Yeah, thanks. That's where it starts. So I mentioned about keeping things simple. Our investment philosophy is to look for three key things in the stocks that we look at. It starts, as you said, with wealth creating businesses. And so to us, that's a company that's really worth more each and every day. If you can imagine a business that can borrow at 5% and reinvest at 10% and do that over and over and over again, well, that's a business that generates wealth. So it's not, it's not the easiest thing to find. Clearly, companies that can generate wealth are bound to attract competition from others, which would drive down the returns that you can generate. So what do we need then to make sure that a company can generate wealth in a durable way, so over many years? And that's where it comes down to making sure that the companies that we own have very strong competitive advantages, that the business model be strong. And that's really what we mean by a wealth creating business. So there are some examples across the bottom of the page. I'll pick on one of them, and that's the one at the far right. We own a company in our international portfolio called Croda. They're a UK-based manufacturer of all kinds of sophisticated compounds or chemicals. So you might imagine the fabric conditioner that goes into a dress shirt to give it its non-iron properties. Or as the picture on the right suggests, the active ingredient that goes into a hand cream. So Croda isn't producing that hand cream, they're just producing the active ingredient that gives that cream the properties that it requires. The beauty of that business model is that, well, these compounds that Croda is producing, they are very sophisticated and often patent protected. But importantly, they are usually a very small proportion of their customers' costs. So whereas they are very important to the functioning of their customer's product, they represent a very small proportion of the cost. And so what that does for Croda and its business model is that it gives it real pricing power. If their input prices go up, they're able to pass those along to their customers. As I mentioned, their compounds are patent protected. That again gives it a degree of pricing power. And for a company like Nivea, which may use Croda's compounds, the idea of trying to find a different active ingredient for a very small amount of savings. Again, remember, these compounds are very small portions of the overall cost of a jar of hand cream. It's just not worth it. So there's a very strong degree of recurring, boring revenues to Croda's business model. So that's what we mean by wealth creation, and I think Croda is a great example.
Perfect.
I would say though that it doesn't end there. There are two other elements of the investment criteria. One is that we're looking to invest over the long term. The decisions that management make over the long term clearly matter. So we're looking to make sure that we're invested alongside able and competent management teams. That's the second piece. And the final one, and this is hopefully pretty common sense, is that we're not looking to pay any price for these great businesses. We're looking to purchase them at a discount. And so we look at these companies under lots of different scenarios and try to make sure that the odds in our clients' favor when we make a decision to invest. But to go back to your original question, Ryan, absolutely, it really does start with the business model. And it's our belief that investing in good, sustainable businesses is the right place to start.
That's perfect, Rob. And you mentioned sustainable, which brings me to my next question, which, we often get the question from our clients of, can we do well by doing good? And what we mean by that is, can we invest in a way where we're generating good returns, but then also making the world a better place to live? And we note that Mawer is a signatory of the UN Principles of Responsible Investment. And so what that means is that Mawer is incorporating environmental and social and corporate governance practices into its analysis. And so I was hoping you could provide a little bit more detail on how Mawer thinks about environmental and social causes when it comes to evaluating an investment.
Sure. So yes, as you mentioned, we are a signatory to the UN PRI. And we believe, first and foremost, that our investment philosophy, the one I just described, is very well aligned with this idea of a responsible investing. However, it's not something that we're going out and purposefully doing. And so what I mean by that is we are not purposely targeting investments that we think will do good and accept a lower rate of return in order to do those investments. So right. As the slide suggests, our primary objective is to maximize long-term returns for our clients, subject to acceptable levels of risk. Now, we do believe as long-term investors, our holding period tends to be, well, ideally forever if we find great companies, but in practical terms, it generally ends up being between 5 and 10 years. We believe that these environmental, social, and governance factors can and do have an influence on the strength of and the sustainability of the competitive advantages of our companies. And so very important to understand them, both from a risk and from an opportunities perspective when we're analyzing businesses. And finally, we believe that integrating these into our process is important. So we don't want to outsource the work of looking at ESG. It's really the work of every analyst to look at financial and non-financial matters, understanding what's material to an investment thesis, and making those adjustments accordingly. So I mentioned Croda on the last page.
Yeah.
And yeah, they're a chemicals manufacturer, so there's there's some amount of footprint there. But where we think Croda has an edge, and where we think that Croda has a long-term tailwind behind them, is that they, relative to their competitors, tend to source a lot more of their raw materials from bio-based materials. And this allows their customers to, put on that hand cream bottle that this product is green. And so, that's not the main reason why we like Croda. I think the business model overall is very attractive, but it's certainly something that's in Croda's favor as well. And whereas we did sign the UN PRI more recently, just given our focus on these long-term great businesses, ESG has always been something that we've looked at because we believe they are material to the outcomes for our clients.
That's great. I appreciate that. And what I thought we could do at this point is move to performance and take a look at historical performance. And so, when we're looking at that, I think, one of the main questions on the minds of most people in the audience is, how do we make sense of today's markets, and how should we be positioning our investment accounts? And during turbulent or volatile times, I think there's this instinctual reaction to want to do anything about it. So we start paying attention to these daily ups and downs. We start trying to time the market based on headlines, but not reacting at all is actually how you're going to generate better returns in the long run. And Mawer, I love this quote that they have. The middle of the storm is not the time to fix your ship. And so I'm hoping you could provide some color on what that means in terms of managing portfolios, and how that leads to some of the performance that we're seeing on the screen.
That's right. I think it ties back to this aspect of be boring. So you got the first half of the quote. I'll fill in the latter half. Yeah. So the middle of the storm is not the time to fix your ship. Rather, the ship should be ready to go before it sets sail from harbor. We're pretty proud of the results that we've been able to deliver for our clients over the years. I think it's one of the reasons why open access has stuck with us for coming up on 2 decades now. Yeah. But I think it's also the manner in which we've delivered those returns, in the sense that they've been consistent with our investment philosophy and the experience that our clients would want. There haven't been many surprises. And so as I think back to this year, clearly we did not anticipate the pandemic. We did not anticipate the reaction that markets would have. The returns that you see on the page are not a result of having positioned the portfolio in the view of how the markets might react to a pandemic. You should take comfort in the fact that, as I mentioned, we're long-term investors. We haven't had to do a whole lot in our portfolios, in the sense that despite the fact that we didn't see this coming, we felt that lots of the businesses that we owned were in good shape. They were well managed, had appropriate levels of debt. Their competitive advantages will endure through a pandemic, and it comes back to some of these boring businesses. Now, in terms of the return experience, I know we're quite a far along way into the year now, and things are perhaps not as dour as they seemed back in March. But I mentioned that consistent experience, and going back to our founder, Charles Mawer, this idea of don't lose money. Well, these are equity portfolios. We were not able to completely avoid the negative returns that the market saw in the first quarter, but we did provide a very strong degree of downside protection, meaning that these portfolios were nowhere near down as far as their benchmarks. And the other aspect of nice, well-run businesses is they tend to snap back. And so we've been pleased with the way the portfolios have rebounded as well. And that's where you see fairly significant added value relative to the broader markets in both portfolios, not just this year, but over very long periods of time. There are certainly periods in which we won't do as well over the shorter term, but again, we think a a philosophy that's centered on something as simple as good businesses, good management teams, and paying attention to the price that we pay for them should result in consistent results for our clients over time.
Right, I love that sentiment about not losing money, and that actually allows you to compound at better rates in the long run. So certainly, those 5 and 10 year returns, that's not only a function of getting the upside, but in those down and volatile periods, making sure that you're protecting capital.
That's the key, yes.
So what I thought I would do at this point is actually drill into each of these different funds. So we'll start close to home, and we'll talk about the Mawer New Canada Fund. So you can see the performance there, but let's talk about how you've been able to generate that. And so for the audience, on the right, what you have is the sector breakdown of the Mawer New Canada Fund. And so where is your exposures? And you can see that you've got a healthy position in industrial companies, certainly real estate and materials, but then you also see information technology, and in particular software companies. And Rob, when you look at this year and some of the companies that have done quite well for the portfolio, it's these software companies. So I was hoping you could look through the lens of the Mawer investment process and give us some insight into why the team likes these software companies.
Sure. So software companies do fit our investment philosophy pretty well. So you can see our top holding is Enghouse. That's a software company. They provide the software that runs contact centers. So if you dial into Rogers, for example, and you go through the system, Enghouse would make a software like that. They also provide software that helps clients manage their fleets. So you think about a taxi fleet or public transportation. They really provide this mission critical software that their customers' business just can't run if they don't have the software. And the other really nice part of the business model, well, actually there are two other nice parts of the business model. First is that the software is typically structured as recurring revenue, so a monthly subscription to pay this to use the software. So that provides a lot of recurrence to the revenues. And the other aspect is that it's really painful to switch software providers. If you've got this thing that's deeply embedded, your entire staff is trained up on it. That again provides an additional layer of recurrence and high switching costs for Enghouse's customers in a business that's very capital light. It doesn't require a lot of capital. You can contrast that to an energy company or a mining company that requires a lot of capital to get the business going, and that allows Enghouse to generate very high returns on capital. By the way, we think it's one of the better management teams in the portfolio. So I would say that there are a lot of aspects of companies that we find in the technology sector that do meet those criteria, that have those high quality revenues that are recurring. The other one on the page would be Descartes. They're a logistics provider. So with companies potentially going forward seeing more complicated supply chains, Descartes is really nicely positioned to help their customers in that regard. What I would push back a little bit, Ryan, is to say that whereas we are finding a lot of ideas in the technology sector, part of the aspect of a well-diversified portfolio is to make sure that it's resilient, to make sure that we're not taking too big of a position in any one given theme or sector or industry. We really want the portfolio to be resilient overall. And so, as you mentioned, just looking at the top 10 holdings or the sectors on the right-hand side, we do feel that we've got a very resilient portfolio in that regard. This portfolio is not a bet on technology. It is much more diversified than that.
Yeah, no, fair enough. And when we talk about these everyday Canadian companies that turn out to be fantastic investments, there may be some of us in the audience and on the call today that woke up and took some Jameson vitamins with their breakfast, and little did they know at the time that they actually had a financial stake in this company. So what does Mawer see in Jameson Wellness, and what's behind its recent rally?
Yeah, so Jameson would fit our investment philosophy very well. From a wealth creation perspective, they've just got very strong brands, and they're 2.5 times their next competitor in size. So that gives them economies of scale. Again, a very strong brand I think when people think of vitamins in Canada, really Jameson is the first name that comes to mind. And it's not very economically sensitive. People are taking vitamins every day, regardless of whether the economy is doing well or not. Another nice part about Jameson that's helped so far this year is just that every day that goes by that we're in quarantine and the pandemic is ongoing, well, habits get formed. So if you're like me, I might not have taken vitamins a year ago, and I'm certainly taking my daily dose these days. And the more that becomes an ingrained habit, the more that bodes well for Jameson going forward with respect to the growth in their markets. So Jameson, absolutely a wealth creating business, one that we think is well managed, and one that we feel we're getting a decent price for at these levels, just given the strength of that business model.
Okay, that's fantastic. And what I thought I'd do at this point is go from close to home and expand out to international. And so we'll look at the Mawer International Equity Fund. And before we go into the specifics of this strategy, one of the themes that we consistently see when we're reviewing this broad array of strategies out there is this prevalent home country bias. And in other words, these portfolios are focusing exclusively on investing in Canadian companies. And at Open Access, when we're building accounts for clients, we're thinking a lot more global. And so I was hoping you could touch on why that makes sense to expand out that opportunity set and include companies trading in Europe, Asia, and the emerging markets.
Absolutely. So, I think the Mawer New Canada Fund is a wonderful investment vehicle. However, I would not put all of my assets or all of my money in it, in the sense that Canada is a pretty narrow market on a couple of dimensions. First, we're pretty small in the grand scheme of things. But second, the Canadian economy and the Canadian dollar and the Canadian stock market do tend to be dominated by these very narrow, in our view, often lower quality business models. So you think about energy companies, mining companies, very capital intensive, no pricing power, completely at the whim of the price of oil or the commodity that they sell. And very, very economically sensitive. So it's not surprising to us that earlier this year, when concerns about the economy were greatest, it's things like the Canadian dollar and the Canadian stock markets that, relative to their global peers, had a lot more negative returns. Mm-hmm. So in a way, we here at home are invested in a very cyclical market. Our currency is quite cyclical in that regard. And if you think about this idea of having portfolio resilience and trying not to lose money, we think having a very, very healthy allocation outside of Canada does provide stability and ballast to your portfolio. One, just because of the Canadian dollar effect, where your investments outside of Canada will be worth more in Canadian dollar terms in an environment where the Canadian dollar is declining. But also, there are just wonderful, more diversified businesses outside of Canada, and we own a number of them in our international equity funds. Wolters Kluwer is a great example. So they provide, if you've been to the doctor, the software that the doctor will use to be able to help diagnose you and treat you. Wolters Kluwer provides that software. So again, it's something that's absolutely necessary for doctors to run their practice, and not something that they're likely to pull back on and unsubscribe from just because the economy is not doing well. Taiwan Semiconductor would be another one. We don't have such investments in Canada. Really, they're the leading provider of semiconductors globally, at the very cutting edge of technology. And this is an advantage that we've seen further evidence of their dominance there with respect to, you may have seen that Intel has postponed plans or has had to scrap and postpone plans for their next generation chips. That's really recognition that they can't keep up with Taiwan Semiconductor, which is one of the reasons that we love that business. So Ryan, I would say a very narrow market in Canada, a very cyclical market in Canada, and the ability to invest in business models and types of companies that we just don't have here at home would be reasons for making sure that you have a healthy allocation outside of Canada in your portfolio.
That's great. And, it's not on the screen, but, I think, whenever we see volatility, our first reaction is to think that that is universally bad for a lot of stocks. And, we note that there are companies out there that actually benefit from these big swings. And one of the names in the portfolio is Japan Exchange Group. And this is an investment that's done quite well this year. And it's not in spite of, but as a result of all the volatility that we've seen. So I wonder if you can walk us through that one.
Sure. So Japan Exchange Group is, its name is very helpful. They're the leading exchange operator in Japan. They weren't too creative there. But the reasons we like that business and the business model in general, we do own another exchange operator in the portfolio, is that they are a quasi-monopoly. If you're going to trade securities, derivatives, et cetera, in Japan, you're doing that through Japan Exchange. And so there are some real benefits to that network effect, real benefits to that scale and that market focus. But when things are volatile, people tend to trade more. And so whereas you've seen lots of banks suffer this year, as you mentioned, Ryan, Japan Exchange Group is just a business that has oddly enough benefited as a result of greater volatility. I would say more generally though, and again, I'm just referring to the names that I see on the screen. I mean, there are lots of businesses that we've held that I would say have been unaffected by the pandemic. So whether it's Tsuruha, which is a drugstore in Japan, that's proven to be an essential service. I wouldn't say that there's been much impact on their business. Intertek would be another example. So Intertek is basically a bunch of scientists all over the world who are testing products to make sure that they meet certain standards in order to, you can imagine toys meeting certain safety standards before they are actually able to be sold. So Intertek's business has been very resilient too. In fact, as I mentioned, if supply chains are going to get more complex going forward, well, that creates a need for more auditing and testing, and we think potentially more business for Intertek. So overall, I would characterize the portfolio as having been more resilient to what's happened in the last 8 months. But there are a couple businesses like Intertek, like Japan Exchange, where they actually might be in better shape now. There might be some tailwinds as a result of the pandemic and greater volatility as well.
That's perfect. And I'd like to wrap up with a question as we look forward here. So, what are some of the key investment themes that you see playing out through year end and as we go into 2021?
Sure. So I'm always wary of these types of conversations because I think at Mawer, one of the real strengths that we have is our culture. And one of the aspects of our culture is humility. So recognizing that we are in the business of making investments, we are trying to forecast the future to some degree, but just being very aware that we don't have a crystal ball. So, we might think that Croda is a wonderful business, but that's not a fact. That's our opinion. We've constantly got to judge that. And when it comes down to what might occur going forward, I think the lesson that we've learned over and over again is that we just don't know. So we've purposely titled this slide as current themes as opposed to outlook. So here are some things that we're looking on. I won't go through all of them. I think the one at the top is an important one, long term, just with respect to the inflationary environment. Currently, there are lots of very strong deflationary forces related to the pandemic, but even going back before the pandemic, but especially now with a global recession, you think of things like Amazon, which make the comparison of pricing around the world just very easy. That's deflationary in nature, and these forces are very strong. But you may be aware that there's a ton of stimulus that's been pumped into the system. The thesis for the last 10 years, and I guess a lot of people have been wrong for a 10-year period, is that the stimulus at some point should be inflationary if you're putting money into the system. What will those dynamics look like going forward? And it's our view that the way that this plays out will be important for capital markets going forward. Now, as I mentioned, we don't really know how that's going to play out. So our approach is to try to be resilient to that, to have businesses in the portfolio that will do well in a deflationary environment, businesses that will do well in an inflationary environment, and ideally companies that will do well in either. but really just making sure that we're diversified with that respect. And I do want to highlight the bottom two bullets on the page: sticking to the philosophy, sticking to the process. And our chairman's most, he's got a list of these inspirational quotes that have guided him throughout his career in investing. And one of them is keep calm and do nothing. And that's not to say that at Mawer we're not doing anything. Clearly, we're every day we're coming into work, doing our homework, researching the companies that we own, making sure that we're staying on top of the latest news. But as I mentioned, the philosophy is very much to think long-term, position portfolios, buy these boring businesses. I'm just thinking back that we've just come through an election, and I'm thinking back 4 years to the last election, and the right move usually is to stick with your knitting, stick with what's worked, be alert, keep calm, but don't overreact to the latest news.
Yeah, I love that sentiment. It's certainly an honest answer, but we appreciate that. In an unpredictable world, the best thing you can do is diversify your portfolio and keep calm through the ups and downs, and that's how you get to those 5 and 10 year returns that we saw earlier. So that's fantastic, Rob. I think that is a great segue to tee up some of the questions we have from our audience. So audience, we have the chat function open now. It should be at the bottom of your screens. And so if you do have a question for Rob or myself, we'll be happy to address those. And as we wait for some questions to come in, I'd like to give our audience a better sense of the investment professionals that are working on their behalf. And so, one of the things that we're looking for when we're partnering with a fund manager is the tenure of the investment team. Although that's something that you do have to be a bit careful of, because sometimes you have a team that's been working together for decades, and you get groupthink where they're all starting to think exactly alike. So you guys get around this by seeking out professionals that don't have that finance background. So, you're adding to the team professionals that have experience in political science or neuroscience, law, electrical engineering. So can you briefly touch on the team managing international equity and some of the diversity in backgrounds and experiences?
Sure. So I think that's right. I'll recap a little bit. I mean, philosophically, when we think about putting together teams and our research team and the firm overall, it goes back to Charles Mawer and this idea of not losing money. And we've talked throughout this webcast about the benefits of diversification to not losing money. One that I think not as many managers are aware of is just the benefits of culture and team to not losing money. And it's based on this idea that, as you said, if you've got everybody thinking the same way, if you don't have the ability to challenge one another on ideas, and you don't come from these variety of perspectives, well, then you might miss something. And so when we look at hiring, we are purposely looking for people who can add a different dimension to the teams. We're looking for different ways of thinking, this cognitive diversity, and I think you really see that across our research team. So, for example, just from a language perspective, we speak 15 different languages at the firm within our research team. We were born and raised in 11 different countries, and that's reasonably impressive, I think, for a Calgary-based firm of 32 research professionals.
Absolutely.
As you mentioned, 18 different educational backgrounds. So it's not just finance measures, but it's PhDs in neuroscience and in law, electrical engineering, just this variety of I think the easiest way of thinking about it is if everybody that you interacted with in your life read the same newspaper, wouldn't you miss out on perspective that might be important? And so that's really been the bedrock of the way that we think about hiring. I think you certainly see that within the international team. In fact, 2 of the team members on our international team are based in our Singapore office. And so just exposure to different cultures, different languages, different ways of thinking about capital markets. But importantly, having a culture where these people can actually talk to each other, where they can respectfully debate and disagree, and making sure that opinions that have the potential to save clients' capital get voiced, but also that they get heard.
That's great. And we do have Kathy, who thank you for the question, Kathy. So Kathy is asking, what kind of company actions would cause you to drop them from the portfolio?
Sure. Really, it goes back to our philosophy, and thanks, Kathy, for the question. Anything that reduces our opinion of a business model's ability to create wealth, and so management can clearly make decisions that reduce the quality of a business model. Anything that we might find out about a management team that we would deem, doesn't make them or reduces our opinion of their ability to allocate capital or to run their businesses properly, or anything that might make us think that we're purchasing an investment at a premium. In other words, we're not getting a very good price. Anything along those dimensions would lead us to sell out of a company. I'll give you an example of a company that we held and that we sold earlier this year, AB InBev. So Anheuser-Busch, the world's largest brewer. This has been really a mistake for us. So this was a company that we've held for many years. We had a very high respect for management, and you may be aware that they went out a number of years ago and made an acquisition of SAB Miller. So this created this gargantuan brewing company, which had economies of scale. People tend to drink beer on a regular basis. It had a decent amount of recurring revenues. But where we made the mistake is this should have been a warning to us that they funded that acquisition not in the currencies of the revenues that were going to be brought in, but rather in US dollars. And so a lot of the revenues come from emerging markets currencies. And as the US dollar has strengthened, and just given the sheer size of that acquisition and the debt that it introduced to the balance sheet, that's not been a very good investment for us over the past 4 or 5 years. And we were slow we certainly had been trimming, but we were slow to really pull the plug on the investment. And I think that's a lesson that we've taken out of our experience with AB InBev. Whenever there is a very large material acquisition, if we have any concerns, better to move quickly to the exit. And so another company that we have in the portfolio today is 7 & I. They're behind the 7-Eleven convenience store brand. It's a Japanese company. They just made a large acquisition of Speedway. And so that's one where we're moving a little bit quicker towards the exit on 7 & I than we had with AB InBev.
That's great. And we have one from Alex that's come in. This is really more about the company as a whole, asking, do you invest in equities as well as bonds and precious metals?
Yes. So I think there was a slide earlier, but we've got a fairly limited number of things that we do. Again, we're trying to keep things simple. Where we think we have a real strength as a company is in the analysis of securities. So I would venture that 80 to 90% of our business is in equity asset classes. And so that would be in Canada. But I think, as Ryan mentioned, we do believe in investing outside of Canada for some of the reasons that we talked about earlier. And so roughly 2/3 of our business are in equity asset classes outside of Canada, like international equity, which you invest in.
Yeah, and then Alex, so as a client of Open Access, speaking to diversification and building these resilient portfolios, every single one of our accounts includes not only cash, bonds, as well as stocks. So we're making sure that you've got exposure to all those different economic situations that could happen. So Rob talks about inflation and deflation. Whatever happens to play out, you've got a part of your portfolio that's going to perform in that environment. So certainly we do invest in equities, bonds, and you do have some precious metal exposure through your Canadian equity holdings. So that's it for audience questions, and I see we are coming up on the time that we allotted here. So this is a partnership between Mawer and Open Access that's been fantastic throughout the years. And so I just wanted to thank you, Rob, and the team at Mawer as well. And on behalf of our clients, wanted to thank you for the time this morning, but also for the great work that the Mawer team is doing in adding value for each of our clients. And big thank you to our audience here today. We'll touch in with anybody that's got any other questions. Please, if you've got questions, comments, thoughts on that, please reach out to Open Access. We would love to hear from you. So thank you very much, everyone, for taking the time. And thank you to Rob for your time this morning.
Great. Thanks, Ryan. And thanks to everybody for your trust.